When I was playing a lot of football, the gentleman we're about to talk to is the guy I like to sit next to. Because then I could stay eligible. He's one of those. Stephan Weiler is a professor of economics at Colorado State University. Stephan, good to have you coming down the road with us.
I really appreciate the opportunity. Thank you.
I want to talk a little bit about what's going on. Obviously, the word is inflation. It's a word that everybody is judging as they drive down the street and they look at that gas price. Is that a good indicator of inflation?
The gas price is probably one of the ones that are most affected. So what the BLS, the Bureau of Labor Statistics, who keeps track of inflation, they keep track of inflation for all goods, and then they subtract out food and fuel because those two tend to be really volatile. So what they call the core index is without food and fuel. But let's face it, I mean, fuel is important, particularly in a state like yours where you have a lot of people driving a fair distance to get to work or just to get to the grocery store. So, you know, fuel is a part of it. But the phenomenon obviously is much wider. I mean, I'm curious. I mean, what do you see in North Dakota that strikes you in particular?
Well, and here's what I see, and it's maybe the guys that I grew up with that are out there raising soybeans and corn. One of those guys told me this week when I was having a beer with him, he said, Joel, when fuel goes up, nobody likes it, especially people like you that drive 65 miles, as you just pointed out, one way into work. But he said, when it goes up, I make money. And I looked at him and I'm like, you know, with that tractor, you know, running out in the field, I said, how do you make money? He said, when fuel goes up, corn goes up, soybeans go up, because we make biodiesel, we make ethanol. And I don't know if you're seeing that just in farm states, but what you're seeing.
We've seen that in farm states, but I mean, also, particularly, I mean, Colorado is kind of a mix of states. I mean, I know Colorado a bit better, but all of our eastern plains are agricultural, and most of them are soybeans and corn as well. So they're getting hit pretty hard, precisely for one reason, because of the fuel that you cite. But everything gets more expensive because Denver's the main distribution point. So everything that the communities need in rural parts of Colorado has to get trucked, and that truck has to run on diesel that costs a lot more. So we've got a third of our state that's really struggling under the weight of this inflationary pressure.
So here's one of the other things I'm seeing in North Dakota. Before Stephen came on, Stephan was talking about, energy producing states, how North Dakota might be a little bit more than Colorado, but yet Colorado is in the oil patch, which is a huge part of North Dakota, a huge part of, our economy. It may not be geographically, but a huge part of what we do here. Mm-hmm. There are people who make money from mineral rights. And of course, they don't have the right to stop an oil rig from getting on their land and drilling down, but they're not going to make money on that mineral rights until they start pumping oil from it. And They call into my radio show time and time again and talk about how, wait a second, they keep talking about drilling on public lands, but yet they don't want to admit that they've got, wells now that they could draw from. And I don't know if you're seeing that in other areas as well.
Yeah, the horizontal fracking. The amazing thing is, it's an amazing technology. I have an economist friend who also was a petroleum engineer for Shell for quite some time, and it's amazing. What they can do. With a single well, they can have a radius of a mile, 2 miles, and so on, to get to break the shale and get the oil in. So. And what it's doing is like in Colorado, we have a little bit of energy independence, in that we only produce about 100,000 barrels out of our refinery, but we do have a refinery, and the refinery sits really close to the oil field. So actually, the transportation of all that stuff is actually relatively cheap. So we actually have relatively cheap gas thanks to the way that oil and the refinery are working together. North Dakota, I assume, has its own refineries too, right?
Not nearly enough.
Really?
not, and we don't benefit from it as much. I'll give you an example. In the Bismarck-Mandan area, there is a refinery, and yet a gas is always about 20 cents per gallon more in Bismarck-Mandan versus what it is in Fargo. And when you talk to them about it, it's because of the competitiveness of the pipelines that come in, and how in Fargo they meet up. That being said, North Dakota has a state mill. The state of North Dakota owns it. That was from back in the 30s when Minneapolis was beating the heck out of us on what they were, paying us for a bushel of wheat. And so we make flour here. We also have a state bank. And that, again, goes to how the banks in Minneapolis were taking us in North Dakota back in the 30s. And so the Nonpartisan League, which was an equal political party, you had the Republicans, the Democrats, and the Nonpartisan League, which some might say NPL was socialists. They in that nature still out there wants to look at the state using what we have in reserves. We've got over $9 billion in reserves in North Dakota.
Wow.
I know. Yeah, all that generated mostly from energy. Well, from energy. And we've looked at whether or not we should build a refinery here. And worst case scenario, sell it. Sell it because we got the money to build it.
Right. Yeah, no, absolutely. I mean, it's the refinery in Colorado, which is the case that I know best. That refinery is really making some, it's not a huge refinery. It's only 100,000 barrels a day, but that still is enough to knock down the prices. I have friends out in California. They're starting to pay $7 a gallon. $7 a gallon is a lot of money. People are starting to, only quarter fill or half fill because they just don't have the cash in their pocket to be able to afford this stuff. So, again, the energy producing folks like yourselves, how far do you have to ship it to refine it? Is that to Minneapolis then?
No, it's what we do is we produce it in western North Dakota. You can do some refinery, down in the Dickinson area, but by and large, a lot of it heads to Bismarck-Mandan. But a lot of it goes, east. A lot of it goes east and some west as well.
Really?
And so the rail industry, the tankers, we had a big fire right on the edge of Castleton, which is in the east part of the state, and it's mostly getting shipped by rail instead of by pipeline like we had hoped, although some pipelines are being proposed. I want to get your take on a scenario that somebody gave me on my radio show. And,
Sure.
And here's what he put out there. He said, all right, in North Dakota, we have unit trains. We have oil trains. Imagine a train with 4 engines pulling it. That's a mile long, a mile and a half long, and you've got to stop. It takes a mile to stop it. You're not going to just stop this train. He said, now compare the economy to that, where that train has to go 1,000 miles. And think of how long it takes to stop it. And he said, most importantly, think of how long it takes to get it moving again. And his point was, until the last quarter of 2023, we're not going to see improvement. And I'm curious what you think about that.
I think the analogy is great. I think that your friend was exactly right. The U.S. economy is like a large freight train or an aircraft carrier, and keeping the momentum going is obviously part of what the economists want to do. But what we have now is sort of an overheated economy. We have people with money in their pockets. People actually saved quite a bit of money during the pandemic. Now they want to sell it. On the other side, the problem is that we've got the Ukraine, which is affecting fuel prices through Russia. It's also affecting fertilizer because Ukraine is one of the largest producers of fertilizers in the world. And then China has a COVID breakdown too. In some ways, the timing of this is all kind of unfortunate. If any one of these things were going on, it would probably be a lot more manageable. But the problem is that they're all happening together and in real time. And so, things like Ukraine, it's really hard to know how long that's going to go on and how long are they going to be depriving the world of Russian fuel and Ukrainian fertilizer. So slowing down that train is exactly what the Fed is trying to do. It wanted to shock the economy and with that 3/4 point rate increase, which hasn't been seen in 20 years, basically. And that's their way of saying we're really concerned and we really want to put the brakes on this, even if it's going to take us a mile. And I think by late 2023, I think we'll be back in reasonable shape. But it's certainly not next month. And I'm dubious. I think we're going to see some slowdown, both in terms of prices and in terms of the economy by the end of the year. But I think 2023 is probably the best we can hope for.
See, to me, people were used to and could easily look at not a devastating thing when they're looking at $3.80 gas. They were used to paying upper 30s at times. They didn't like it. They didn't like it one bit. Believe me, I didn't like it either. But it wasn't as though it didn't happen in the past. I have to ask you this: how big of a factor has the Biden administration been on what we're talking about?
That's the problem, is that the government itself and Congress included, one, they have a hard time making decisions about anything, as we've known. I mean, that's been going on forever. And even in a crisis like this is actually one of those situations where there's not a whole lot that they can do. Biden is going to reduce tariffs. We put up those tariffs a little while back on Europe and some of Asia. And in order to relieve prices a bit, he's going to reduce those tariffs. It's not going to be a big deal, but it's at least going to help a little bit. But in a lot of ways, it's also up to Congress. And Congress has been a particularly difficult place to get things through. I mean, at the moment that Democrats have the House and Republicans have the Senate, things are going to move slowly. And that's exactly what's happening. Everybody agrees that there's a problem. Not everybody understands exactly what to do about it. Which leaves the Fed to do a lot of work. And using interest rates is a useful tool, but it's very blunt in the sense that it doesn't attack inflation directly. It makes business loans more expensive. It makes mortgages more expensive. And with those more expensive items, people will start, not demanding as much, and the price pressures will start easing as well.
Last question, I promise. Is corporate America, some people, let's use oil as an example, are they stealing? Are they using this for political purposes? We're seeing record profits. Yes, they're starting to pump a little bit more oil, but they could pump more. And so I have to ask you, they're no friend of the Biden administration. They want permits on public lands. They're already pumping on public lands. They just want to do new drilling on public lands. And they're not drilling, I shouldn't say drilling, they're not pumping on what they've already drilled. And so, let me put it this way. Are they stealing?
Stealing is a strong word. But I mean, one of the problems with both the companies and with oil, and what's surprising is when you drive the main highway, you see a lot of the gas wells stopped and not pumping, and you think right now they should be pumping, 24/7 as hard as they can. But the problem is that a lot of the producers are a little skittish. I mean, they've seen demand, go through the roof before. And the problem is that, if this suddenly does disappear, if this inflationary work of the Fed starts working again, they're going to be back down to $50 to $40 oil, which gets to them back to, barely break even point. So the uncertainty of the economy is actually a big part of what is hampering oil companies from going too far forward. As far as the CEO stealing, I mean, stealing is a strong word, but it's really hard to ignore the fact that they are having record corporate profits, as you pointed out, at a time when prices are going up through the roof and supposedly making it more expensive for consumers. Consumers definitely see things that are more expensive. But the nice thing is with rising prices, it's much easier to hide. It's much easier to hide profits. And I think that they may not be stealing, but they're taking advantage of the situation to increase their bottom line. because those margins are really fat. I mean, they are making a lot of money, and that's difficult to reconcile. But the issue is that the American economy has been really concentrated, like in oil, where you have a few producers that dominate. It's like beef and cattle, which is big in Colorado. Basically, there's 4 companies that control that particular commodity. And so these companies, if you have these small numbers of companies, there's no competition. And competition for economists is what keeps prices down. And so what really is, I think, happening here is that the Department of Justice has an antitrust group, and I think they've been saying that everything's okay as long as prices don't increase for the consumer. Well, that's out the window now. Yeah. And so I really hope that the Department of Justice starts going after some of these concentrated markets, because it's just making things harder on everyone.
Yep. Stephan Weiler, ladies and gentlemen. Thank you, sir. Thank you for coming on.